Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Thursday, everybody. Before we start with the main stories, there is something to briefly cover. As of filming, there has still been no public sign of General Secretary Xi Jinping for almost 2 weeks now, with the last public event being in Hong Kong for the 25th anniversary of the territory's handover. This has sparked some speculation of issues behind the scenes, or perhaps that he is in quarantine because he was in close contact with a Hong Kong official who subsequently tested positive for COVID. Other analysts argue that it is premature to engage in such speculation, and the absence is likely related to the preparations for the 20th Party Congress. There have often been periods in the past when key leaders are not seen in public for several weeks, so the absence is not without precedent. Of course, we do not know what is going on, and we will only find out in the coming days or weeks. Now, let's move into the main stories. BA5 is spreading like wildfire through the country, with at least 7 major cities detecting cases as at the recording of this video, namely Xi'an, the capital Beijing, Shanghai, Dalian in the northeast, Tianjin, which is near Beijing, Qingdao in Shandong province, and Zhuhai in the south. Commentators suspect the unofficial list is likely longer too. Now, another city has been placed under lockdown too. Yesterday, Wednesday, the city of Lanzhou, population 3.8 million, provincial capital of Gansu, reported a total of 143 locally transmitted COVID-19 cases. 4 main districts are now under a 7-day lockdown. Residents must stay within their residential compounds and work from home, except for those working in critical roles. In addition, multiple cities in central China's Henan province have temporarily sealed off parts of the city in the last 48 hours, and Zhuhai in the south, China's Guangdong province, has recently shut down all schools, including kindergartens, after a kindergarten teacher was found positive on Monday. Now, with that, let's move to China's economy. Yesterday, China's State Council convened its weekly executive meeting. The meeting readout focused on measures to stabilize employment, with the Premier, Li Keqiang, stating that China will introduce stronger policy steps to keep payrolls stable and boost job creation in an effort to stabilize overall employment, and that local governments must fulfill their primary responsibility and see that employment targets are met. So, this year, local governments are being told that they must meet employment targets, meet growth targets, stabilize debt growth, and implement zero-COVID policies, all while their revenue is being hit hard. The State Council also approved a plan to carry out major work relief programs in projects in order to boost employment. The plan clarified work relief programs in sectors and key projects including transportation, water conservation, energy, agriculture, and rural areas. Meanwhile, the People's Bank of China, China's central bank, at a press event yesterday expressed that liquidity in China's interbank market is more than reasonably ample, to use the language of the bank, an indication that further interest rate cuts are unlikely. The head of the central bank's monetary policy department told media that the view of the bank is, quote, "The economy has bottomed out since May as domestic COVID outbreaks eased," end quote. Well, we will see. Financial analysts are speculating that Beijing is growing concerned that households are saving too much due to shocks to household confidence in recent months. This hurts already weak consumption, which regulators and local governments are trying very hard to boost in order to stabilize the economy. A June survey of urban bank depositors by the People's Bank of China found that people's confidence in their future earnings potential was at its lowest level since the initial Wuhan outbreak. A record number of respondents, 58.3%, said that they intended to increase their savings rather than their spending or investments. New household loans fell to a 7-year low. Now, while we're still on the economy and speaking of weak demand, according to data released by China Customs yesterday, Wednesday, exports bet expectations and grew by 17.9% in June from a year earlier to $331 billion, compared with 16.9% growth in May. However, imports were flat, growing just 1% year-on-year and down from 4.1% growth in May. The trade balance climbed to about $98 billion last month from $79 billion in May, reaching the highest level in at least 3 decades. Now, analysts have mixed thoughts about this data, with some arguing that this is evidence of strong performance, strong export performance, and that this is a sign of economic recovery in June. Others, however, argue that strong imports would be a better sign of recovery, and that strong exports but flat imports suggest weak domestic demand, which is what the economy needs. If you guys are enjoying the video or getting some value from the video, don't forget to hit the like button. It's a huge help. And for anyone who wants to go the extra mile and help me keep this channel sustainable, Patreon and Buy Me a Coffee links are in the description below. As always, thank you so much, everybody, for the ongoing support. This week, international and domestic financial analysts are discussing the troubling development of homeowners beginning to walk away from unfinished apartments at dozens of projects across the country, raising fears of financial crisis from a source regulators always thought was a safe part of the market: households with mortgages. According to Citigroup Inc. analysts in a research note published yesterday, buyers of 35 projects across 22 cities have decided to stop paying mortgages as of the 12th of July due to project delays and a drop in real estate prices. The Beijing Daily has the number even higher, saying owners of 52 projects have decided to halt mortgage payments, and it's widely believed that this number is going to continue to increase. According to the Citigroup report, non-performing loans triggered by people walking away from mortgage payments could reach as much as 561 billion yuan, about $83 billion, or about 1.4% of the outstanding mortgage balance. At this point, this issue is manageable. The non-performing loan ratio of mortgages is well below the level of other forms of lending, but it is certainly exacerbating an already crisis-hit industry and raising fears of wider systemic issues. Meanwhile, on Monday, the Hong Kong Stock Exchange's Hang Seng Composite Index removed 6 Chinese private property firms, including China Evergrande Group and Sunic China Holdings Limited, because the companies had been suspended from trading for 3 months and had still failed to disclose their 2021 annual reports. Others included Kaisa Group Holdings Limited and Shimao Property Holdings Limited. These are, of course, all developers that we have been following closely in recent months. Financing for Chinese developers was decimated this year, especially on global bond markets. According to recent data from the China Index Academy, the amount of foreign bonds issued by Chinese real estate companies in the first half of this year plummeted 91.1% year on year. Also this week, a Bloomberg index of China's high-yield dollar bonds fell to the lowest level in a decade as of Tuesday, and domestic bonds also slumped to record lows. Okay, that is today's episode of China Update. Thank you so much, everybody, as always, for watching. I'll see you tomorrow.